Good day, all. My name is Abafemi Oyewumi. I would like to welcome you once again to the elements of cost accounting session in the class, and we're looking at material pricing. In this particular session. Okay, when we talk about material pricing, it relates to the determination of cost of material components of a product and its related valuation. Of stock. So now you know that you keep material for the purpose of using it to produce or to maybe if you keep finished goods you want to sell. Okay, and then at what price are you going to value the stock issues for the purpose of production, or maybe stock issue for the purpose of sales. So that's a focus in this particular session. Okay, I said this has to do with the calculation of the cost of issuing stock into the production processes. Again, furthermore, if you are not producing, you also have you buy and sell materials, you buy and sell goods, that's stock items. So you also have to determine, you have to calculate the cost of of the units that you are giving out for the purpose of being sold to your customers. Okay, so let's look at methods of valuing material issues. Okay, so methods of valuing the issue of materials. Okay, there are several methods. Number one, we have first in, first out, that's FIFO. We also have last in, first out, that's LIFO. We have simple average price. And we also have weighted average price. We also have standard cost, method. We also have replacement cost method. They come with different, variants and of course different ways of calculating, stock materials that you're issuing out of stock for the purpose of producing goods or for the purpose of selling them to your customers. All right. So it's imperative that we talk about stock letter cards. This is a record usually maintained in the accounts department to keep records of receipt, issue, and balance of each stock item and the value of such material at any given time. In the store, they maintain what is called a bin card. Okay, so when materials are brought to the store, there's a bin card for every material item. So it should, the addition, you have the receipt, then we also have the issue, and then the balance, the running balance. So when goods are brought to the store, it is recorded in the column of the receipt. When it is given out of the store, it is taken as issue, and then the balance automatically will be deduced based on the interplay of the two. Okay, now in for the stock ledger card, this is usually maintained in the accounting department. Okay, and basically what they do is the components of big card is reflected in the stock ledger card, but then the only difference is that stock ledger card brings in the value component. Okay, the value component and the cost component, or the and the cost component of whatever it is that you are dealing with there. So it usually provides details necessary to ascertain materials value and for checking of physical stock of materials. All right, so let's continue as we look at the first type of the first method of valuing stock, out of the store of stock issue. So this method deems that stock are being, we're talking about first in, first out now. Okay, first in, first out now. That's what we're looking at this moment. So deems that stock are being issued from the earliest batch delivered until it is exhausted. The earliest batch delivered until it is exhausted before taking from the next delivery. So what this means that you issue stock from the first batch. When the first batch is exhausted, you go to the next batch. When the next batch is exhausted, you go to the next batch. So it means that you don't touch the latest goods coming in. You start with the first and you keep on, deducting or taking from it, or using the value or the cost at which they came in, batch by batch before you before going to the next one. So you say in other words, the first batch of materials received are issued first. The first batch of materials received are issued out first. The units of the opening in the use in the opening stock of material are treated as if they are issued first. The units from the first purchase rather, are uh, uh, issued next, and so on until the units left in the closing stock of materials are valued at the latest cost of purchases. Okay, this method is most suitable in terms of falling prices because the issue price of materials to job or to work order will be high, while the cost of replacement of material will be low. Advantages: it is easy to operate, the value is based on cost, and so no profit or loss will arise. Okay, the stock balance will represent a fair commercial valuation. Valuation, and then the last one is the method ensure that the other materials are issued out first. The other materials are issued out first. Let's look at the second type, which is last in first out. Last in first out. Under this method, issues are priced in the reverse order of purchase. Reverse order of purchase. So what does that mean? The price of the latest available consignment is taken. That is what this one means. The latest, of the latest price of the consignment is what is usually, taken or used, for the purpose of giving out, determine the price at which you issue them out, to the store. Okay, so that's last in first out. Okay, say that the last batch will be the first to go out. So the price at which the last one came in is the price at which you're going to issue out your first, item to be taken either to the store or for the purpose of being sold out to the public or to your customers. Therefore, has the advantage of ease of operation as well. Okay, and that the charge to production is as closely related to current price levels as possible. Okay, so that's the advantage, okay, of LIFO. Assuming the purchase of material was in recent time, it will not be necessary to ascertain, market value. Okay, in terms of inflation, LIFO is considered to be the first system of pricing because of the high priced purchase um, or purchase are charged to production while the stock are retained at low prices. So that's for LIFO. The one uh, you know part of it, the disadvantage is also given. The disadvantage is that although stock is at cost, the price of the element materials purchased so that it does not represent. Okay, let me get that one correctly. Okay, disadvantage is that although the stock is at cost, the price is that of earliest material purchase, so that it does not represent current price levels. Okay, as it as a result of which it may be necessary to write off stock losses during the period of falling prices because this book value of materials will exceed market value. Other disadvantages include it usually involves a considerable level of clerical work that you have to do. The valuation of stock balance may not be accepted for income tax purposes, and that's true. I put it there. The tax authorities do not favor the system in Nigeria. Using stock valuation on the older materials in the stock may present a false working capital position in the balance sheet because in most cases what it means that is the first batch that you value as your inventory value that you have as inventory value in your statement of financial position. So usually tax authorities do not allow for this to be used in Nigeria. So let's look at the next one, which is average, simple average. In this method, price is calculated by dividing the total of the prices of materials, okay, in the stock from which the material to be priced could be drawn by the number of prices used in that total. So look at the example given here. In 2012, we have 1,000 units purchased, another one 2,000, another one 3,000. So what is the price at which you're going to issue out 3,000 units here? You have to look at the average, simple average. This is 10 plus 11 plus 12, that's 33. So divide by 3 by 3. So we're saying that you calculate the total um, price, the different, the total of the prices, that's 10, 11, 12, divided by number, that's 3. Then you arrive at the figure 11, as the case may be here. Okay, that's what you are going to have at the end of the day. Okay, but of course you say that this may result in charge to production not being the actual cost because you are not using the actual cost here. You are only using a derived cost for you to be able to issue out your stock to the production process, or you usually to the maybe to your marketers to sell, for the organization. Okay, now let's look at some work examples. Okay, I have only one part, specifically, but of course, replicated in two places based on what we have, there. So McDavis Limited buys certain type of stock item for the purpose of its operations, for the purpose of its operation. Okay, for the purpose of its operations. The following the following uh, are a summary of the receipts and issue of stock item. Okay, the following and the summary of receipts and issue of stock item for the month of July 2019. Opening balance, we have 2005 at 5 units. Please, I beg your pardon here, it's supposed to be following. Okay, July 5th, received from vendor 4,000 units at this price. July 11th, 2,150 at this price. Received from vendor again 3,300 units at 5 naira 80, and then received from vendor 2004 units and then at 6 naira. Okay, so they came at different times and the different prices. Okay, then let's look at the issues of stock items for sale now, not production, for sale, were as follows. January 4 2002, 2200. January 10, 3,400. January 15, 1,100. January 19, 1,200. January 26, 2,000. January 30, 2005. Now you must take note of these dates, okay, because these dates will come in between the receipts. So take note of them when you want to calculate and want to determine your pricing. All right, so look at this. So 10. So 10 will come after July 5. Then 15 will also come, after July 12. And then January 19 will come even after 15th. So look at this positive that you look at. So you're required to write the store ledger account in respect of the materials for the month of July 2019, and then determine the gross profit of selling the stock items if they were sold for 10 naira. Okay. Um, for the purpose of this particular session, I've calculated, and then drawn up um, the 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 store ledger account where it should appear if you answer, correctly. Let's look at the solution given here. The solution given here. Now we have material process work example. So this is something that I just worked. I've done before now. On July 1st, remember I'm looking stock value 2,000 units, and then look at the price at 5 naira. So this is the value. Okay. Then on 4th of the 4th of on the 4th of July, okay, there was an issue out of stock. Look at it, 2,200 units. So take it. So after July 1st, then the next transaction that took place was July 4. What happened there? There was an issue of stock out of the store. Okay, so you have 2002. Now, at what price will it be taken out of the store? Because this is what we're concerned with. At what price? We are concerned with everything basically. Okay, the receipt, the issue, and the balance. Look at the way it is formatted: date, quantity, price, value for each category. So issue also have quantity, price, value, balance, quantity, price, value as well. So you have 2,200 to be taken out of the store. At what price? At the price, initial price given, that's 5 naira. If you look at the question, you have it there. Okay, that opening balance is at when 2005 at 5 naira. So when you are also issuing, you are issuing at the rate of 5 naira. Look at the value, it's 11,000. So what you have to do, you have a running balance. Deduct 2,000 from 2005, you are left with 3,000, and then multiply by 5. You have, so the balance is what you have there at the end of the day. Then on the 5th of July, 4,000 units were brought to the store at 5 naira 20 kobo. Look at the value of the amount of the total of the goods brought to the store. Then that's 4,000 that came into the store at what price? Out of the 5 naira to 20 kobo. Then that gives 20,800. Now what you have to do, add the two together. Now I've been able to be done this explicitly so that everybody will be able to I've tried to do this as explicit as possible, okay, as clear as possible, so that you'll be able to have understanding, of what I did. It's possible for someone to just go through this without putting all this sort out, figure there. So what I did, the 300 added to the 4,000 that has been supplied, and you have 4,000 free. That's the quantity that you have and the value of the stock that you have as at the 5th of July. Now, on the 10th of July, a total units of 3,004, okay, were meant to be taken out based on what you have in the question. On the 10th, 3,004 units. Can you see this? 3,004 units. So let's go back and see what we have here. So 3,004 units, should be taken out. But then, at what price would they be taken out? Now, the constituents, okay, will come from two batches, the part of the opening balance and then the latest supply. So because we are doing FIFO, the first one must be taken out before we go into the next batch. So these 300 units, here, which are standing in the first batch, will first go at what price? 5 naira, because everything there was at 5 naira. So 1,005, and then you come here, deduct the 300 from 4,003, you have 4,000, and then at what the this is the price that you now have left, 5,000 and 5 naira 20 kobo, and then this is the price that you have. Then the 3,000 units, 3,100, the balance of 300 and 3,000 3,004, that's 3,001. So that one now coming at what price? At 5 naira 20 kobo, which was the latest, at before that day. So you have this there, and then the balance is now four. It's now three. It's now 900 at 520, and this is what we have. So the next stock of items that came in was 2,150 units at 550, 5 naira 50 kobo rather, and then this is the value. Add down to the outstanding, that will give you 3,500, 2,050, and then you have this total stock of value, as of that day. Now, on the 15th of July, 1,100 units of stock was taken out. So you have to go back to what you have. 900 units, remember, as at the last count, okay, that's now that you exhausted it now at the rate of 520 kobo, that will give you 4,680. And then the other batch you are taking from is the latest batch, because you've exhausted the old batch. So you move to the next batch. You're taking 200 out of your 2,150. So that's what you have here. At what price? 550. That's the price that you're going to use, and then that's what you have. Then do your subtraction. Okay, 200 from this, you arrive at 1,950, and then the value now is that's the unit price, is that 550 kobo, and then 10 naira, 10,725. Okay, and then on the 19th of July 2019, 1,200 units, okay, were actually issued out at the rate of what? 5 naira 50 kobo. That's what you also have left, and then that's 6,600, and then having deducted, by the time you deduct 1,002 from this, you are left with 750. At what price? 550, 4,000, that's the value. Then on the 20th, 3,000 units came in at what price? 5 naira 80, and then this is the balance, and then you have 3,300 multiplied by 5,000, 5 naira 80 kobo, so you have 19 naira 1. So when you add the two together, you arrive at this particular figure. On July 25th, excuse me, 2004 came in at this price, then this is the price. So you do the needful. This time around now, what we're going to do is to the balance of stock that came in at 5,000, 5 naira 550 kobo, the balance of stock that came in again, okay, of this particular date now, that's 3,000 units. We also brought it down here, and then at what price? 5 naira, and then the latest one here is 2,000. So the cost total figure is 6,600. That's the unit, and then this is the balance that we have. Okay, and then we come here to talk about the issue. Okay, now they issue out 2,000. Now this the 750 will come from the oldest stock left, that's 750. Then 1,000 units will be taken out of the next batch of the oldest stock, earliest stock, that's 3,300. Okay, so that's 505 naira 80 kobo, and that's what we have. Then you have that's the total that came in, and then this value that came in, and then you have this value at the end of the day. So you also the last thing that was taken out was 2,005, the last quantity 2005. 2005 will be made up of 1,750. Okay, from the LS stock of the remainder here. Okay, so you have to take it out because you took out 1,250, so that's 1,750 at 5 naira 80 kobo. That's the value. 300 at 5 naira 80 kobo. Okay, also to be taken out of the store. Okay, at that particular price. Okay, and then you now have what is left. That's 450. 450 now have it multiplied by 6, and then you have 2007, and at the end of the day you have 1,950 units valued at 11,700 naira. So that's what you have. So at the end of the day, you've been able to you brought in 11,850 units, then valued at this price. You issued out 12,400 units valued at this, and then of course you got a balance of 1,950, and then a balance of 11,007 as the value of the closing balance. Let's look at the second part of the question: calculation of the gross profit. Selling price now. Remember, you sold 12,000 units. That's the quantity issued out. 12,004. Look at it here. 12,004 sold at 10 naira according to the question. So you arrive at 124,000. Opening stock. Remember 12,500. Purchase. Total purchase is 66,166. If you look at it, 60,100 is there. 60,000. That's your purchases, and then your closing stock is 11. So you come back here and say our closing stock is 11. So add this together, is what you have minus this. Then you have 566,966, and then you have a gross profit of it. Or just multiply the gross. This total sales of 12,000, that will give you 124,000 minus cost of total cost stock issued out, which is 66, and then you have at the same. You can see that it's tallying, and then that shows that you have actually got your question your answer correctly. Now let's look at this one this time around. Now let's look at LIFO. Okay, the same type of question, and then LIFO. Now, so what do we do in LIFO? It's simple, but it's a little bit technical. Okay, that's why I said that this one will take a considerable number of clerical work earlier on that we said. So you still have your opening balance of this. Okay, and then you're taking out your first stock 2002. Okay, out of the store, that's 2002 multiplied by 5, and then that's at this rate. So you're left with this. Now you took out there's a need for 3,004 units, 2,400 units to be taken out. So at what price? We're taking that at the price of the latest stock. So you can see now we didn't bother with the earliest one. We took this 5,005 naira 20 kobo. So it's taken out, and that's what you arrive at. By the time you do your computation very well, you can try this one later on to calculate to confirm all these figures. So the next item of stock came in. The next batch 2,150 at this price came in, and then now issue of 1,100 out of the store. Now you have to take this out of what? Out of the latest stock, because we're using a last in first out. So you still leave this one, the balance of this 300, you leave the balance of this one that's remaining here, and then you go for this one. That's the latest, that's coming in, that came in. So you're taking it out. So the next one is 1,200 units. 1,200 units. So you're going to take from the difference, okay, the balance that you have of this figure. Remember 2,150. Okay, you are going to take from it. So 2,150. You are already taking out 1,100. So the next one is 1,050. So you are taking only 1,150 at this same price out. Now, having exhausted this one, you now go back to the latest, the nearest old stock, which is this. So 150 is taken out at this same price. So you are issuing out of stock, and that's what you have. Now you got this that came in, and then this one that came in at different, times. Okay, and then now the next stock to be issued out was 2,000 units to be issued out. At what price? The latest price. You can see one price came in, one stock batch came in on the 20th, another batch came in on the 25th, and then you are using the latest. So the latest is 2004. So you take 2000 from 2004 at the what price? 6000. So you are left with 400, up there. So you have 400 left there basically. So 2000 taken out of this at what price? This is the price, and then you have your running balance here, and then the last batch to be taken out was 2005, okay, of stock. So what do you do? At what price? It's going to be at the price 400 would go from the last batch, and then the nearest to it will be the 3000, which you now be taking out from. So 2001 will be taken out of 3300, and then this is the price. So you have 1950, and then this is the running balance. That's the value of the stock that you have at the end of the using last in first out. Now let's look at the determination of our gross profits. As usual, you have your total number of goods sold. That's units that you sold. And what you have there, you have 12,000 units multiplied by 10 naira, and then that's 124. Opening stock removal giving 12,500. Purchases same thing, 6,165, and then the closing stock is different from that of FIFO, and that's where we're having a difference. This one now is resulting into a gross profit of 656,135. Okay, look at the other one. What did we get? We got closing stock of 57. I mean gross profit of 57 and 35. 57 and 35. You know. Naira. Now let's look at what you have there. This is 56, 135. If you look at the other method as well, you also have at the same figure. Okay, so there's a difference between the gross profit when you use LIFO and the gross profit when you use FIFO. Okay, so that's coming to the end of this particular session, and I want to appreciate you for being part of it thus far. I hope you have learned one or two things, as well. Now subscribe to my YouTube channel, okay, where you are watching this from or where you are listening to this. Okay, subscribe to it, like or comment your comments, and then I'll also come back to the same page to be able to answer your questions as the case may be, if there is any question. So if you like it, just share that you like what you have seen in the place. Thank you very much. If you have comments, put there. If you have questions, put there. I will attend to them as much as possible. Thank you for being part of the class. God bless you. Thank you.